Good morning, everyone, wherever you're listening from, and welcome to our webinar, which is aimed at providing a market update and price outlook for selected food commodities for the first half of 2021. My name is Tosin Jack, and I'm the Commodity Intelligence Manager at Mintec, and I'll be moderating today's webinar. And I'd like to start by introducing the other speakers today. So we've got EB Doniboye, who covers soft commodities and will be presenting on the soft commodities category today. We've also got Yarazika, and he covers the nuts and dried fruits and spice markets, and he'll be presenting mainly on the nuts and dried fruit market today. And lastly, we've got Ramnik Kula. He covers the fruit and vegetable markets, and he will be presenting on those markets today. So I would like to start with an agenda today. As we all know, COVID-19 underpinned commodity markets most of last year. And basically, for every news or articles that you read, you always see the word uncertain, unprecedented. But today, beyond COVID-19, we also recognize that we had region-specific market drivers. For example, in Europe, there was the double whammy. It was from Brexit. Not America, we had the US presidential election, which, then impacted commodity prices. In South America, it was about the weather, mainly the La Nina weather event and how it was going to impact commodity markets. Asia, particularly, we had strong demand from China, economic recovery, and a lot of demand in different commodity markets. And also in Asia, we had high shipping rates, and all these factors generally impacted commodity markets. So what we've done is we've been able to use our data and platform to create category indices and bespoke dashboards to see commodities that experienced significant price movements. So this basically informed our decision on commodities that we will be presenting on today. EB will start by giving a 6-month update on the soft commodities category. So it's an overall commodities update on where we are to date and the price drivers. And then it will go into a deep dive to give an outlook on the coffee markets. It will pass on to Yara, who will then give a nuts and dried fruit category update with a deep dive into the almond market. And then Ramnik will do the same thing for the fruit and veg category with a deep dive into the orange juice market outlook. And lastly, I will just give a quick overview for the other categories. So the grains, oil seeds, meat, and dairy core categories, I will just give an overview of what we expect the price drivers to be for the first half of the year. So before I hand over to EB to speak, I would like to highlight a frequently asked question across the food commodities market, and as really has been, how can we be better prepared for uncertainties? And this is because we had the black swan uncertainty of COVID-19 that people were not really expecting, and so there's been a lot of question of how can we be better prepared. And whilst we know that we cannot eliminate uncertainties, is about making sure that we minimize the impact. And this is how Mintec has been able to help its clients. We've been able to help our clients by improving price visibility. We have more than 14,000 price series on our platform. So we've been able to help our clients make well-informed purchasing decisions and improve their budgeting and generally to control their spend. So, and in summary, lesson learned so far is very important to have access to independent data in a timely fashion and in the right form of technology that you can use as you desire. So I will now pass over to EB to take us through the soft commodities market and a price outlook for coffee, which particularly has been impacted by extreme weather events and also is something that is linked to economic recovery. So over to you, EB.
Thank you, Tosin. Hello, ladies and gentlemen. Good morning or good evening, as it were. I will kick off the presentation looking at an index basket of 4 commodities. So I'll be looking at cocoa, Arabica coffee, Robusta coffee, and sugar. And I'll be looking at these key benchmarks at the intercontinental exchanges in Europe and the US, which are obviously the major benchmarks for these commodities. I'll be looking at the prices, the index basket of prices, the performance in the second half of 2020, and the index is indexed to January 2020. So I think the first thing to say is that the notable rallies, if you can see 3 major, I guess kind of 2 major run-ups and a downturn, which were primarily related, I would say the 3 major keys are the COVID-19 pandemic, as well as the weather and geopolitics. I could also put I guess currency, foreign exchange under the geopolitics as it's a key driver. So if you look at the first one up, where the index increased by 17 points, and this is the 12 weeks ending the 9th of September. During this period, the Arabica benchmark increased by 36%, while Robusta increased by 20%. Cocoa also increased by 9% over this period. And the key themes that underpinned this was, firstly, very low stocks, both in coffee and cocoa. This was related to domestic inventory drawdowns due to the disrupted seaborne trade attributable to the COVID pandemic. There was also poor weather in Vietnam during the crop season, which impacted the Robusta harvest, as well as the weak US dollar, which fell against key currencies. And a weak dollar generally pertains to strong prices at the exchanges due to the currency exchange from the exporting markets. We then saw the index soften by 13 points during the 8-week period to 4th of November. And again, coffee and cocoa really fueled this decline, with Arabica falling by 20%, cocoa declining by 10%, and Robusta by 7%. Now, the key impact here was, firstly, a very large Brazilian Arabica crop. It was a very huge crop, and this was helping to replenish some of the lost stocks, or some of the low stocks that we'd seen previously. The US dollar also strengthened by about 1% during this period, as the growth in pro-Trump sentiment increased in the run-up to the American presidential election results, as well as the COVID-19 pandemic weighing again on demand, particularly for sugar and cocoa during the Halloween period, which is the key demand period of the year. So this was weighing on the index through this period. Then if we look at the last run-up, which was during the 4 weeks to the 2nd of September, it increased by 11%. Cocoa was the main driver here with 17% increase, with Arabica up by about 14% also, and sugar up by 8%. And the factors here, again, weather. There was few weather events during this period. Firstly, the La Nina in Brazil contributed to very dry weather during the key flowering stage of the Arabica crop. And we also saw hurricanes in affecting the Central American coffee crop, so particularly Honduras and Nicaragua, which are key suppliers to the exchange, as well as the poor weather that I mentioned in Vietnam. And we can also look at droughts in West Africa that impacted the cocoa harvest during this period. There was also some slight optimism surrounding the COVID-19 vaccine developments, which could potentially highlight that there could be improved economic activity and sentiment going forward. Moving on, and a bit of a deeper dive into the coffee market, as mentioned. So after dipping below what is seen as a key support level of about 100 cents per pound, which is how it's generally measured in the New York Exchange, this occurred in June. The Arabica benchmark rallied strongly over the next 3 months, and it broke above the key 130 cents per pound resistance on the 9th of September. As mentioned previously, there was a strong inventory drawdown during this period due to the effects of the COVID-19 pandemic on seaborne trade. Now, port stocks were at almost 20-year low during this period in September. So it's about 66,000 tons available in all the ports around, in all the seaports around the main hubs. And comparing this to March 2019, where it was about 150,000 tons, you can see how these really thin inventories really supported this price. And the Robusta, excuse me, the Robusta price increased by 22% during this period, so it's about $259. And this was in the 10 weeks to the 2nd of September. And this was the weak Vietnamese supply, Vietnam being a very key, the largest global supplier of the Robusta strain. And droughts, very dry weather during this period contributed to thin supply in Vietnam. And during the 2 months ending 4th of November, the Arabica benchmark fell by 20% to almost near the resistance level of 100 cents per pound, while Robusta fell by 7% over this period. So the key factors here was that the Brazilian harvest had just ended, and there was ample availability of Brazilian Arabica, Brazil being the primary low-cost producer of global Arabica coffee. And with the Robusta, Brazil was also had a very strong production that year. So we saw the falling demand that we could attribute to the COVID-19 pandemic was also offset to some degree by high Brazilian production of Robusta, as well as high Indonesian and Ugandan production of Robusta. And as I mentioned previously, the US dollar rallying on the growing pro-Trump sentiment just prior to the presidential elections. And in the 8 weeks ending on the 30th of December, so finishing the year, the Arabica benchmark increased by 17%, gaining back towards where it was at the highest point in September to 126 cents per pound, with Robusta just increasing by about 3%. So the Biden win in early November on the presidential elections helped. It weighed on the US dollar. So a weaker dollar was seen because of that, due to firstly improved investor sentiment, also the likelihood of less stringent currency controls and protectionism, which was a key feature of the Trump administration. The dollar weakened against the Brazilian real by 10% during this period. A strong real would generally translate to a strong US dollar denominated price for the Arabica, due to Brazil being one of the main, or the major global supplier. During this period, we also saw the Brent crude price rising back towards $50 per barrel, $50 per barrel for the first time since the start of the pandemic, which is a key indication of, firstly, economic improvement and also investor confidence. And we had the weather impacts of La Nina drought risk in Brazil, as well as we said, the carryover from the hurricanes Iota and Eta in the Central Caribbean. And we also saw a wet Colombian harvest. So this was impacting the ability to garner some of the Colombian beans, which also tightened the market. And moving on, quickly look at the supply and demand drivers for coffee. So the USDA estimate that total global coffee output is expected to increase by about 4%, so almost 500,000 tons to 10.5 million tons in the 2020-21 season. The Arabica is forecast to increase by about 7% during this period, whilst Robusta is expected to increase by about 0.4%. As mentioned previously, the sharp drop in Vietnamese production will be offset by strong Brazilian growth, as well as growth from Indonesia and Uganda during the period. And on the demand side of things, the USDA expects demand to grow by about 1.6% year on year this season, whilst the agricultural bank, Rabobank, expects roughly similar, about 1 to 2% growth. So overall, global ending stocks are likely to increase, with supply expected to out-accelerate out accelerate demand during this period, which presents a slightly bearish undercurrent to the current bullishness in the market. And I will round up with our outlook for the 6-month period, so for H1 2021. I guess the first thing to say is for both Arabica and Robusta, there is no consensus. The market is completely split on how they see prices developing over this period. My view is, or our view is, that mildly bullish tone to prevail for the next 6 months, and the key bullish factors I anticipate to drive prices that we're seeing at the moment. Firstly, the weather in Brazil, as mentioned, the dryness during the key flowering period of the crop is really weighing on expectations for the 21-22 crop, which normally gets priced into the market around May. At the moment, there's a school of thoughts that they'll lose between 20 to 30% year on year compared to the really firm harvest we've seen. It's also Brazil going into the biennial off year of the Arabica cycle, which is always lower than the previous year anyway. Then also got the impact of the poor weather in Vietnam, as well as some of the impact we've seen from Honduras, where about 5 to 10% potentially was lost from the hurricanes. The weak US dollar is another factor that would expect to play a bullish tone into the market, particularly as we see Joe Biden ascending to the presidency in the US, and I'd expect to see a continued weakness or weak tone to the US dollar compared to other currencies, particularly as economic recovery is expected sometime, maybe in the second or Q2 2021, as the COVID vaccine development gives rise to more optimistic economic outlook, and this will feed into, as I said, to more investment in emerging market economies, pulling money out or pulling investment out of dollar and taking more riskier bets. So we expect to see some weakness in the US dollar over this period. And again, the demand recovery, it's expect to see between 1 to 2% as predicted by Rabobank and the USDA. But just to caveat that, regardless of those bullish factors, there's obviously a bearish undercurrent. Firstly, the COVID-19 presents continued uncertainty with the threat of further lockdowns, as we've seen in Europe, rising cases of the virus also in North America. And we should also take a look at the high level of stocks. Even though we expect to see a tight Brazilian off-season crop for the Arabica, there's a sense within the market that there's actually a lot of stocks available, particularly given that Brazil had a very solid, robust harvest that's just finished. So potentially the beans that are being put in storage, both certified stocks and private stocks, are likely, or some see it, they could actually offset and filter into the market to offset the tightness for the upcoming crop. So these are the key factors, and I see between 0 to 5% increase, average price increase from the previous 6 months for the first 6 months of 2021 for both Arabica and the Robusta crop at these key benchmarks. So that concludes my presentation. I thank you all for listening, and I will now pass on to Yara, who will talk to you about nuts and dried fruit.
Thank you, B. Before Yara steps in, just to an intro into this, the almonds market, where prices reached a decade low in the second half of 2020. So Yara will then take us through this also, particularly because there's a lot of interest in the market with the move away from on-the-go snacking to baking and cooking at home, and yeah, just generally seeing an increase in demand for this. So Yara will take us through that. So over to you, Yara.
Thank you, Tosin. Hello, everybody. Can you hear me? Good morning and good afternoon. And yes, there have been some interesting developments in the almond market over the past 12 months. And like you, Tosin, like you mentioned, it would be, I would say, quite interesting to see what's happened in the snacking on the go, and as well as the snacking at home, or what's happened at the retail level when we talk about not just almonds but other nuts or dried fruit. So on my first slide, I would like to start off with an update on the nuts category as a whole. On this chart, I've plotted an index consisting of key nut markets. So what you can see here are almonds, hazelnuts, peanuts, walnuts, cashews, pecans, and Brazil nuts. And as you can see, there has been a big dip over the past 12 months. The index fell about 13 points between January and August, and there has been some recovery in nut prices since then, but overall the index remains down compared to last year. So let's now have a look at some of the key factors affecting the nut category over the past 6 months. So I would like to start with the food service and tourism. We have seen here varied impact, I would say, on the nut category. Some nuts have been affected more, some less. The almond category has seen a bigger impact. Companies who supply almond flour or marzipan, for example, to patisserie channels, these have been hit really hard over the past several months. Or, for example, when we look at salty snacks in pubs, in case of the nut category, we talk about peanuts or salted cashews. Companies supplying nut snacks to schools, train stations, or airports, which brings me to tourism. Because people have been just simply traveling less, this has impacted sales of luxurious items, luxurious chocolates at airports or at holiday destinations. Some nut categories, such as walnuts or pecans, have experienced a decline in demand from bakery channels, and prices for these nuts have eroded as well over the past 12 months. The snacking on the go is down as well, as people work from home or in general have curbed their outdoor activities. That means people snack less for breakfast or lunch, and people snack less while traveling to work or just traveling in general. This has affected all sorts of nuts, but also dried fruit for commodities such as raisins, sultanas, or dried apricots, which are key ingredients in products such as cereal bars or protein bars. On the other hand, we have seen a very strong retail sales. Snacking at home has increased since the start of the pandemic for the same reasons as I mentioned before. People just spend more time at home and snack at home. Consumers have replaced their pop salty snacks with evening television snacks. What we have seen at Mintec by talking to the industry is that people have been turning away from branded nuts to cheaper private labels. People are spending less money and often buy larger pack sizes. The nut market has been impacted by trade disputes, trade tensions. Just to mention a few examples, China continues to impose large import tariffs on a large number of US nuts, and towards the end of the last year, the EU imposed large tariffs on US peanuts due to the due to the Boeing dispute. As for the currency effects, the major markets for the nut and dried fruit segment, the US and Turkey, have experienced major swings to their respective currencies to smaller or bigger extent. Dollar, even as Ibi mentioned, dollar is currently down. If I'm correct, is about 10% compared to euro against the same time last year. And it has weakened substantially since the presidential election in the US in November last year. The Turkish lira, which is a key for the nut and dried fruit market, fell to an all-time low towards the end of the last year. Recently, it has firmed, but it is still well below last year levels. Of course, the weakness in both currencies translates to lower prices in export markets. On the other hand, it might help to drive demand, as we have seen with the almond category over the past several months. Lastly, on this slide, the sharply increasing shipping rates in the past several weeks, but the trend goes back several months, is a key factor as well, which will see prices rising for nuts and dried fruit commodities in destination markets. So moving on to my next slide, I would like to talk about almonds, a market I mentioned on my previous slide a few times. So as you can see on the chart on the left, prices experienced a big dip in 2020. The market fell from a close to $3 per pound at the beginning of 2020 to $1.75 per pound in August. A decade low for this market, and this prices for California standards priced free alongside ship US. Simply said, the market has been under pressure from robust supply in California, with the crop this year expected to reach a record 3 billion pounds. Last year, the production eventually exceeded the official estimate, and this meant that there was a very good carryover into the current season, and these firm supply fundamentals have just really put pressure on the market over the past several months. As you can see from the chart, prices firmed in September. That's the little spike towards the end, and this was because of the bushfires in California and concerns over the nut drying because of higher humidity, and also as the transition brought larger crop and a tighter availability of larger caliber nuts. Prices came down after that again, but in general, if you look at the trend in the last few months, we have seen kind of an upward trend in the market. So let's now deep dive a little into the market fundamentals. As I mentioned, the industry is very well supplied with almonds. California is having a very good crop this year with a record carry-in, and these are really the key supply factors weighing on the market at the moment. The demand side is probably more interesting and less predictable, I would say. California continues to ship large almond volumes, which indicate strong demand within the supply chain. And this is, of course, very much down to the very competitive prices almonds have been selling for recently. Shipments from California are quite ahead of the last year. The volume currently stands above 1 billion pounds for the first 4 months of the new season through November. You can see the shipments are charted on the right hand side. That's the red line, and also the volume of commitments. This is what has been sold but not delivered is up, if I'm correct, over 50% on the previous year, and so far close to 60% of the crop has been sold. and this is in comparison to last year, where there was about 53% of the crop sold at the same time there. So there is a quite increase in shipments and commitments compared to last year. The question now the industry faces is, will California be able to maintain the strong pace of shipments? I would say for at least another month or two, shipments should be strong, and this is obvious from the strong sales throughout November. Looking more forward, we can probably move on to our next slide. Which brings us to the price outlook for the next 6 months. The market will continue, as I said, to be under pressure from abundant supply in California. There's no question about this. Will the strong pace of shipments continue in 2021? That's the question. The global demand for almonds is robust, as I said. This is also supported by the weak currency, by weak dollar. But we believe the pace of shipments will slow in the next few months as buyers, as companies have bought more stock at very competitive prices, have sought additional cover, and will simply decrease the buying activities for a time being. We saw this already in the November shipment report, although the numbers point to still very strong, robust demand. The volume of new sales actually dropped in November, in the November report from October, and we expect this trend to continue in the next few months, which will of course cap the upside momentum of the market. We do not expect prices really to drop back to the lows of August, so I would not expect prices to go back down to $1.80 per pound. However, with the great stock availability and the possible slowdown in sales as the almond season progresses, we do not anticipate the market to increase substantially. We rather believe prices could be attacking the $2 mark, but very likely not exceeding this level for a time being. This could, of course, all change with the bloom on horizon in California in February. But assuming normal weather conditions, the expectations for the next crop could be large again, based on the steady increase in California's almond acreage, and despite the anticipated increase in tree pullouts in California, as prices are very low. Thank you very much. That's all from me. Over to you, Tosin.
Thank you, Yara. So great insights around the, Californian market. So now Ramnik is going to take us through the fruit and veg market. This market in particular has been impacted by factors such as Brexit, and of course it's quite a seasonal market, so seasonality has been a factor as well, and also more recently demand has been supported by consumers needing to boost immunity in the wake of COVID. So Ramnik will take us through this and then give a deep dive into the orange juice market. So over to you, Ramnik. So I'll just need to probably Ramnik is on mute, so just get him to unmute it. Okay, it looks like we've lost Ramnik there, technical issues. So I will, whilst Ramnik's dropped off due to technical issues, I will probably move on to the other core categories whilst we fix Ramnik on that side. So
hi, Tosin. Sorry, I think
I will start. Give a quick overview of the grains and oilseeds, meats and dairy markets. These are the key, the core categories, overall. So this is an overview. So I will not be giving an outlook. It will be a summary of what we expect prices to do going forward. I have to emphasize that what we're doing here is just like an overall thing for the globe. So there will be regional specific differences. So this is an overall global outlook in terms of price expectation. So I will start with the grains market. So what we've seen that overall we're expecting it to be bearish for prices to go down. This is compared to the last 6 months. So for the half of the first year, we're expecting that the markets will be bearish for the first half of 2021, driven by market fundamentals mainly. So we've seen record global supply forecast for wheat and maize in particular this season and even for the following season. And of course, we've had lower demand, particularly for fuel, with less movement in the wake of the pandemic. However, there's a need to watch out for the impact of La Nina on the South American maize crop, which could then tighten supply and thus support any form of price increase. So for the grains market, it's really about how the weather develops in the second quarter of this year, which is critical to wheat development and maize plantings. And in summary, any weather effect in the second quarter of this year will determine the overall price direction for the grains market. On the oil seeds and oils, that's a different story. It's actually opposite of what's happening to the grains market. With prices expected to be supported, by tight supply. So prices are currently really firm. We've got into historic highs, for palm oil, for soybean oil, and we expect it to remain firm, through the first half of this year. As I mentioned, driven by tight supply. We've seen strong demand for US soybean in terms of crushing and also export demand from China. So we've seen positive crush margins and strong Chinese demand. And so the market typically looks to the South American crop around February, March. But now with the La Nina weather events and concerns around this, there's concerns that South American supply might be tight. So expectation of a tighter global market, we might start, and also what we then expect is that we might see some demand rationing soon until it's clear what's happening in South America. And although after the first half of the year, we should then see some supply response, farmers probably planting more, but in the first half, it's really tight, and so the market is bullish. And also there's the bullish vegetable oils complex, which is supported by high palm oil prices, as I mentioned earlier on, tight supply following weather events in key producing regions. There's also been labor issues relating to COVID-19. All these factors have made palm oil prices really strong. So it's really about the vegetable oil complex, and that how that market will go on. The vegetable oil complex will really determine the price movements going forward. For the meat category, it really will be regional specific. So this is one market that I expect you to take, with a pinch of salt in terms of we're seeing it's kind of generally bearish due to lower prices expected for beef, lamb, and pork because of lower import demand expected from China due to the strong herd building. So they've built their herd strongly. So we're not expecting imports to be that strong. However, with the occurrence of bird flu, poultry prices are actually high, and we expect them to be firm, particularly supported also by the shift to cheaper protein. So people have actually been demanding more chicken, which has supported chicken prices. So overall, beef, pork, lamb, kind of bearish, which has made the overall meat category bearish. But then for the chicken prices, it's the opposite. And lastly, It's the dairy market now. So we're overall slightly bullish for dairy. And when we say slightly bullish, is because we're expecting prices to move up to pre-COVID levels after they dropped a lot due to um, lower food service demand. And so this price recovery would be mainly driven by strong import demand from Asian and Middle Eastern markets. And also we have higher retail demand as people have kind of now adjusted to the effect of COVID-19 on demand. We also have higher feed prices, which will impact production cost. However, for New Zealand, we need to keep an eye on the La Nina weather, which could result in higher milk production for the first half of the year, just because of the good pasture volumes. And also something very critical in the dairy market is also the U.S. government support, which ended in 2020. So, which we might see a loss in demand on that side, which could make the US dairy market bearish in that sense, but it's kind of a wait and see thing to see what the the new US president does in terms of support in the country. So that's a quick overview of these categories. But of course, if you have any questions, or I know it's a quick one, but any questions, anything you want to know more, there will be opportunities to ask your questions. And in light of that, I think we've got Ramnik back. So we'll go back to Ramnik's section now to take us through the fruit and veg market. So over to you now, Ramnik.
Okay, thank you, Tosin. Good afternoon and good morning from wherever you may be listening to. Apologies about that. I had a slight technical glitch. So today I'm going to be talking about, firstly, the fruit and vegetable index, and then I'm going to give a deep dive into the orange juice market, and then the outlook for H1. Okay, so if you look on the left-hand side, you can see a fruit and vegetable index, which consists of orange juice, potatoes, onions, and apples. Yep, and what we can see from here is that since July, there has been a mainly upwards trend, and that has been supported by bullish onion and bullish orange juice markets. Bearish sentiment from potatoes and apples has capped some of these gains and led the index down a downward path, mainly after November, and that's because of the Indian onion market. So I will briefly touch upon the key bullish commodities impacting the index before moving on to some of the bearish commodities. So US orange juice and Indian onions have helped move the index upwards for the first 5 months of H2. The average US orange price rose 10% to 1.19 pounds per dollar in the second half of 2020 compared to the previous average in the first half. The price increase was largely due to stronger year-on-year retail demand amid COVID-19. Consumers across the US and the globe are responding to the traditional reputation of orange juice as a healthy beverage with key nutrients linked to improving the immune system. Although currently demand is lower than witnessed at the peak of the pandemic, so we can say around March and April, but demand still remains higher year on year. In addition, US production for the 2019 and 20 marketing year outturned 10% lower. The US produced 297,000 tons of orange juice due to fewer oranges available for processing. I will go deeper into the orange juice into the next slide. So in terms of the onions, the average price of onions rose by 22% to 31,700 rupees per metric ton in the second half of 2020 compared to the average in the first half of the year. The price rise can mainly be attributed to tighter fundamentals due to an uptick in onion demand following the reopening of the food service sector and adverse weather conditions impacting key onion producing states such as Maharashtra. So what's actually happening in the onion market is that fearing tight supplies, the government in September banned all exports across India for all the other varieties. This did help control prices. In addition, what they did, the government, so usually traders would stock supplies of onions and release it onto the market when the prices are high. But the government in this case imposed like stock limits. So they said to each trader, look, you can only store, 100 tons of onions and that forced traders to release them on the market, and that led to some bearish sentiment. India also started to import from neighboring countries such as Afghanistan. So generally speaking, they became with the arrival of the Kharif harvest, they slowly started to become a sentiment of the bearish market started to come across, and then there's a price reversal in November, and this prompted farmers and traders to demand the removal of the export ban in order to avoid a supply gut when the Kharif harvest comes in larger volumes in the coming months. In response to these concerns, the Indian government lifted the export ban from the 1st of January 2021. So in terms of the gains in the index were capped by bearish potato markets and apple markets in the second half of 2020. The average price of potatoes in Europe declined by 26% to 178 euros per metric ton in the second half of the year, compared to the average in the first half of the year. So higher year-on-year stock levels and weak potato demand due to COVID-19 contributed towards the lower average prices in the second half of the year. We can see that demand and supply is currently imbalanced, with ample supplies across Europe, negating any marginal uptick in food service demand. And in terms of Brexit, there was a limited impact on prices on potatoes, with both the UK and EU markets currently oversupplied. Moving on to apples, the average price of apples declined by 33% to 0.17 euros per kg in the second half of the year, compared to the average in the first half. The price fall can be largely attributed to easing retail demand and projections of higher production in the 2020-21 marketing year. So now I will go into a deep dive into the US orange juice market. So as explained earlier, there has been a rise in the US orange juice price, and there's been significant volatility throughout the year. Tighter supply fundamentals have led to a 10% rise since H1 2020. Tight supplies as a result of adverse weather conditions have been a key contributor to an increase in global, not just US, but global orange juice prices, and have led to lower volumes of oranges available for processing. If there's lower volumes of oranges, that in turn impacts the processing cost of orange juice. Also, an increase in the average price has been as a result of firm retail demand and a downturn in production in key orange producing states such as Brazil and Mexico. So I'm going to go into the fundamentals in a little bit more detail. So on the demand side, retail demand for orange juice has remained firm and has been higher year on year during H2. Consumers, like mentioned earlier, fearful of contracting coronavirus, have been seeking to boost their immune systems by loading up on orange juice. So we've seen US and global consumers rushing to stock up on the juice. However, overall orange juice consumption has been capped by lower food service demand. Reports suggest that the increase in retail demand has not yet done enough to offset the losses in orange juice coming from the hospitality sector. So we've seen demand on the whole rise on the retail level, but decline on the hospitality level. But we expect an uptick in H1 once the COVID-19 vaccine has been deployed, which I will mention or talk about in the next slide. So on the supply side, global orange juice production for the 2019 and 20 marketing year outturned 23% lower year on year to 1.6 million tons, as production in Brazil and Mexico fell with fewer oranges available for processing. So some of the figures that I mentioned on this slide will be referring to the 2019 and 20 marketing year. Brazil's orange juice production was 27% lower year on year at 0.97 million tons because of fewer oranges for processing. Brazilian orange production fell by 19% to 15.6 million tons, and that's due to the biennial production cycle of orange trees and some weather-related issues. However, with lower supplies, Brazil still remains the largest producer and is projected to account for over 3/4 of global orange juice exports. Moreover, US orange juice production fell by 10% to 297,000 tons, again due to fewer oranges available for processing. And Mexican orange juice production declined by more than half to 90,000 tons due to significant reductions in orange supplies for processing. Orange production in Mexico has been largely affected by droughts. And moving on to the outlook for orange juice markets in H1, the average orange juice price is expected to increase by 3 to 6% over H1 and be on average in the 1.23, 1.26 pounds per dollar region. The US orange market is expected to continue rising on the back of lower US and Brazilian orange production. However, gains are likely to be capped by an increase in Mexico production. So all the production figures that I talk about on this slide are going to relate to the 2020-21 marketing year. So on the supply side, more than 90% of America's orange juice is made from Florida's oranges. So the current USDA forecast projects Florida's crop to be 56 million boxes, which is 2% lower than the initial projection in October. If realized, this will be 17% lower than last season's production and be a bullish price driver for orange juice markets in H1. So US orange juice markets are also likely to be supported by Brazil's recent forecast of their current crop, which has been reduced by 18 million boxes. The industry in Brazil continues to harvest and process the current crop. As mentioned, Funda Citrus has recently cut the forecast on production to 269 million boxes from 287 million boxes in September. While most industry sources say the reduction was more or less in line with the industry expectations, I think that we're going to get a clearer picture in February 2021. So next month, I think we'll get a clear indication of where production is likely to be. Higher Mexican production is expected to hold up the price rise in H1. However, an uptick in food service demand following the deployment of the COVID vaccine is expected to keep prices firm. Currently in Mexico, processing of orange juice has slowed down. Producers have run the early mid-season fruit and are now waiting for the quality of the Valencias to improve. So the forecast for orange juice in Mexico is 200,000 tons, an increase of 122% from 90,000 in the previous year. Why the Mexican production impacts the US market is because a lot of the Mexican production is exported. So reinforcing the price rise are the tighter supply fundamentals from low-end stocks. So the low-end of stocks are reinforcing the tighter supplies, with ending stocks for the 2020-21 crop forecast at 136,000 tons. In terms of demand, the deployment of the COVID-19 vaccine across the globe in H1 is expected to have a positive impact on the food service sector, and we are likely to see a rebound in orange juice demand from restaurants and schools. This is likely to increase sales in the hospitality sector and act as a bullish price driver for the US orange juice market. Thank you.
Thank you, Ramnik, for the insights. Just watching the time now, I'm very conscious of time, and so quickly bring it all together, because we've talked through a lot of factors, and so in summary, we know that the developments around COVID-19 remains key to commodity markets. So on one hand is about the vaccine and how quickly demand can recover, which we don't expect, it's not going to fully happen in the first half of the year, but, it's definitely one to monitor. On the other hand, demand could still be dampened by lockdown measures and news around new strains of the virus. So it's still really very much a wait and see thing. Secondly, weather events is something that we've talked a lot about across all the categories today, and it will be key to price developments, very, very key to the fundamentals as well. So it's important to stay ahead of weather developments and insights to help assess the impact of the weather on various crops through key development stages. So a key way of doing this is actually through weather analytics on our Mintec analytics platform. It's a really great tool that helps you, see the weather developments in one place. So you have the data, the insights, the intelligence, everything in one place to just continue to track this. And lastly, we expect some price volatility depending on macroeconomic news. For example, I mentioned the vaccine development, how fast that will go. And so it's very key to pay attention to currency fluctuations, particularly the US dollar, the Brazilian real, Turkish lira, that have been mentioned today. These are very critical to key commodity markets. So I think overall that brings us to the end of the presentation. Thank you so much for staying with us to the end. Hopefully you found it useful. But this then naturally leads us to the questions. We've got quite a number of questions, but then considering the time, we will take a few and we will get back to you. So if we don't answer your questions now during this webinar, we will get back to you. So I will start for one for Yara. It's saying, is the US almond price comparable worldwide?
Hello, Tosin.
Yeah, Yara.
It's a simple answer. Yes, it is. So California is the benchmark for almonds, right? It accounts for over 80% of almond production, so it dictates global prices. At Mintec, we also track other origins. We track Spain, and yes, the price from California moves in line with the Spanish prices. And then it of course depends what kind of variety grade you're looking at. So if my presentation was about the standards. Obviously the non-pareils are quite expensive, and same can be said about the Spanish almonds. If you're looking at the Marcona, if you're looking at Comuna, if you're looking at Largueta, the prices are different, but in general they follow each other. As I said, because California sets a global benchmark in the almond market.
Yeah, great. Thank you. Thank you for that, Yara. Whilst you're here, Yara, the other question is, can you explain why the prices for hazelnuts have increased while the almonds market has gone down? We would expect both markets to be parallel. And in view of that, there's another question I will merge. It says, do you have a graphic for just hazelnut? I'll pick up on the other one. So yeah, you can go on the price movement.
So yeah, it's true that the almond prices have fallen over the past 12 months. As I said, it's mainly down to the large supply in California, and I wouldn't say the hazelnut prices have really increased, but they have when you look at the local market in Turkey. Whether you're looking at the prices for in-shell hazelnuts or whether you're looking at hazelnuts free on board Turkey, prices have gone up, but in Turkish lira, right? So there has been a firming trend in the Turkish lira, but when you convert that into, for example, into US dollars, which I have the price in front of me right now, let me just find it. I can say that it's actually decreased compared to last year by slight 2%, but the price has kind of fluctuated, and a lot of this is down to the fluctuation in lira. So, and maybe answering the other part of the question, would you expect both markets to be parallel, to move parallel? Again, I probably wouldn't expect them to move parallel, because both almonds and hazelnuts are intended for different end markets, for different consumer markets. So hazelnuts, most of the hazelnuts is produced into hazelnut spreads, and it's a market which is very much controlled by the biggest processor, the biggest hazelnut spread processor in the world. It's Ferrero. So they kind of have some kind of control over the hazelnut market or over the prices. And almonds, again, a lot of almonds are used in snacks, in a retail. When you can buy packs of almonds, consumers would not normally go and buy packs of hazelnuts. It's kind of more high-end nut, I would say, to snack on. So it's quite normal that these two markets move in different directions.
Yeah. Thank you.
Tosin, sorry, there was one more question. Do you have a graphic index only for hazelnuts? Yes, we do. We track prices in Turkey and we track prices in the European Union for hazelnuts.
Yeah. Thank you, Yara. And also, I'm just going to take probably about a couple more. There's quite a number of questions around our indices and the data that we've used. Just to so the indices we've chosen, as I mentioned at the beginning of the presentation, is we use our data and platform to create category indices and bespoke dashboards to help us see how prices are moving. So for the purpose of the presentation, what we've done in order to keep things concise and to keep graphs concise, we've blended prices to then see what's moving. So these are bespoke indices, and it's just a showcase, really a showcase of what you can use Mintec's platform for. You can blend a lot of various price series just to compare prices to see how prices are moving. So if you have any specific questions or any requests for any particular price series or data, reach out to us and we will be able to take that on. There's a question on what % do you expect vegetable oil to increase? So for the purpose of this presentation, as I mentioned, we blended it all together, and to expect a bullish, I would expect it to be in the double figure range. But could you reach out to me? Then we could work out the specific time frame that you are interested in and the specific vegetable oil, because what we've done now is the whole complex, but it will differ by region, and it also differ by the veg oils in particular. But overall, we see that in the double digits area. And I think one final question would be around some in terms of the commodities that we've chosen. So the commodities today are, as I mentioned, were significant, like the ones that have really seen significant price movements in order to keep it to the time frame. So there's questions around wanting to know about the fish market. So reach out to us and we will be able to give you more information. It's just there's so many commodities to cover, and today we've mainly touched on the ones with significant price movements, and we've also touched on core categories. But we know that that's a lot. There's more questions around wanting to know more about other commodities. So please reach out to us and we'll be able to support you as required. So thank you very much, everyone. As mentioned, these what you see on your screen now, contact details. Just reach out to us, and we'll take it from there. Thank you.